Welcome in, everybody. It's Ed the Trainer. And I'm sure that we've all seen the daily headlines running right now that rates are low and there's never been a better time to refi or buy. FHA, it's lowered its monthly MIP premium, so you have to refi now to save money. Companies and loan originators alike are flooding everything from mailboxes to the airwaves to Facebook feeds in an attempt to make hay while the sun shines. But let's take a minute to consider a different meaning to this old saying. And that's what's coming up next on this week's Tips on Tuesday. So mortgage industry professionals are very, very busy right now. And if you pay attention to financial news at all, you've seen that we're in somewhat of another refi boom of late. So of course, the industry and consumers alike are attempting to take advantage of this brief window of opportunity while it exists. So let's all jump in all the way around, right? But those in the industry should consider some lessons learned as recently as a little less than 2 years ago. This chart shows the 30-year Fannie Mae 3% bond and its volatility over the past 24 months. In a candlestick chart like this, the higher the price of the bond, the better the 30-year rate. It's a more direct measure of what's happening with the 30-year interest rate than the 10-year Treasury, which a lot of people follow. Take a peek all the way to the left in April of 2013, and we may remember those all-time lows in rates and all-time highs in volume. Then came June 19th of 2013 and Ben Bernanke's announcement of plans to taper the stimulus that was pumping money into the mortgage bond market. It was a relatively brief press conference after a regular Fed meeting that month, but it sent the mortgage industry spiraling downwards and rates shooting up nearly 1.5 points within about 10 days. Fast forward now to April of 2015, and we're again hearing lowest rates, never been a better time, hurry before rates go up. And there are obviously valid reasons to characterize this moment in such a way, and certainly to focus lots of your energy trying to refi in this market makes sense too. Make hay while the sun shines, right? But let's not forget what the market looked like in the months after Bernanke's announcement in 2013. It was essentially dead in the water, unless you had previously built other avenues of business to lean on, like purchase money. And that brings me back to my point in the open. What does making hay while the sun shines mean to you? You see, to many, it simply means to exhaust all of your resources and energy and maximize an opportunity while it's available. Make as much as you can now. But if you look at the root of this proverb, which first appeared in print in 1546, it also describes the opportunity that farmers took to stock up while they could to be prepared for harsher weather, so they could continue to feed their livestock. So, while we should absolutely not miss an opportunity now for you and your clients to capitalize in a great market, ask yourself this: what are you doing now to prepare for your bad weather? What will your business look like when this low-rate environment disappears? Because it will. Are you building or nurturing the relationships now that'll help you to create those other avenues of business? Now is the time. While everyone else is too busy today, dedicate some portion of your time for tomorrow. The investment will pay off when you need it to. Now, speaking of Ben Bernanke, this week's question of the week. What is the most commonly recognized nickname for the former Fed chairman? Leave your answers in the comments section below me here, and we'll randomly draw a winner from all of the entries with a correct answer at the end of business today. As always, thank you for spending a couple of minutes with me today, guys. I hope you have a great week, and we'll see you soon.